Hey everyone, and welcome back. So on this channel, a while back, I used to talk about Phil Town quite a lot on this channel. He's a 4-time author. He has a massive YouTube channel, and he has a program that he teaches in his books on his YouTube channel, and I think elsewhere as well, where he basically teaches a simplified version of Warren Buffett's key investing principles. Phil Town also manages an investment fund that actually has over $100 million worth of assets under management. So like other big funds, every quarter we can look to the SEC filing to see what the portfolio looks like now, and as a result we can also make some comparisons to previous quarters and see what new investments Phil Town, like other big successful investors, are making during the quarter. And for value investors like Phil Town, during most quarters there's really a lot of inactivity. Usually nothing too much is happening. However, last quarter he made two massive investments. One I'm sure you've heard about, which was in Alibaba, and the other, which you might not have heard about, which was in Sprouts Farmers Market. Now, I'm actually not going to talk about Alibaba in this video because every man and their dog who has a YouTube channel has pretty much spoken about Alibaba and given their opinion and a breakdown on the company to this point. So I'm going to leave that for now. If you're interested in hearing my thoughts on Alibaba, then feel free to let me know down in the comment section, and maybe I can do that in the future. But in today's video, I just want to focus on the other massive investment he made, which was in Sprouts Farmers Market. And there's actually quite a lot to learn here, not just about the business, but also about his options strategy, his options contract strategy in order to invest into this business and actually to make some income while he was waiting for the stock to get to an appropriate price. If you do get some value out of today's video, as always, I would very much appreciate it if you take the 2 seconds to leave a like on the video, and make sure you hit that subscribe button if you want to stay up to date with content that I post in the future. But with that said, let's jump into it. The first thing I just want to say is that finding the SEC filing for the Rule 1 fund, for Phil Town's fund, is extremely difficult because the fund doesn't just stand alone. It's actually made up it's a component of the larger World Funds Trust, which reports to the SEC. So I want to give a big shout out to Investing with Tom, who has a YouTube channel and has done a breakdown on Phil Town's SEC filing and his trades in the latest quarter. He is the source of where I was able to find the SEC filing, and I'll leave his channel and the original SEC filing linked down in the description below if you're interested in checking either of those things out. But within the latest SEC filing for Phil Town's portfolio, we can actually see that the fund owns Sprouts Farmers Market stock for the first time. He holds 470,000 shares worth approximately $5.7 million, and according to Investing with Tom, who did a full picture of his portfolio, this represents just under 5% of the fund's assets. And even though this is the first time that the Rule 1 fund has owned Sprouts Farmers Market, we actually already knew that he probably held at least some stock in the company, and that's because in the previous quarter we could see that he had some put option contracts that he had written for this stock at a certain price. The price was $28 per share, and as a result, because the stock is below that price, we can be confident, or we could have been confident before seeing this SEC filing, that he did have to buy and was forced into buying some shares into this company. So in the previous SEC filing, you can see that Phil had written 650 put options contracts, which represents 65,000 shares of Sprouts with a strike price of $28. And I know that options contracts are really confusing to a lot of people, but I think it's actually worth me spending a couple of minutes explaining as best I can how these kinds of contracts work, because Phil Town has a very interesting strategy for collecting income before he is investing in a company, before the stock for companies he wants to invest in has gone down far enough for him to commit to that investment. A put option is a financial derivative, which is a fancy way of saying it's a financial contract between someone who is the buyer of the contract, so that's the first party, and the writer or the seller of the contract. So the person who writes the contract, it's just a fancy way of saying that they are selling this contract to somebody else on the other side. So let's first talk about the buyer's perspective, the person actually buying this options contract. Well, the first thing to think about is that when they buy the options contract from somebody who is writing it, they are paying a fixed fee. We call this the option premium. So they're paying to buy into a contract. And what that contract says for a put option is that they have the option or the right but not the obligation to sell a stock at a certain price. So essentially, they are paying a small fee, a premium, to have the option, but not the obligation to sell shares at a fixed price. And whether or not they execute that contract, whether they take up the option or they let it expire worthless, depends on what the stock price does leading up to the expiration date of that contract. So for example, let's say the strike price of this contract is $28 per share. If the stock price for that business fell all the way down to, say, $20 per share, then the person who bought that contract, remember they paid a fee for the option to sell at $28 per share, the person who did that would of course execute that contract. And the reason why is because if the stock's price in the open market, in the general market, is $20 and they have the option to buy it or to sell it at $28, they can of course execute the options contract. And what would happen is they would buy the stock in the open market at $20 and then sell it through the options contract for $28 and keep the profit, which would be $8 per share in this case. $8 per share minus the premium that they paid for that contract, because that contract was not free. Of course, maybe it cost them $1. So maybe they had a $7 or an $8 profit from the difference between the buy and the sell, and they paid a $1 premium for a net gain of $7 per share. But let's talk about the seller's side, or the correct terminology is the person writing the put option. So for the person who is writing and selling these options, when they immediately sell that option to someone, the first thing that happens is they receive that fixed fee. They receive the option premium for selling that option contract to the buyer of the contract. And because it's a contract that gives the other person the option to sell stock at $28 per share, if the stock stays above $28 per share, then that contract will expire worthless. And the person who sold that contract, that wrote that contract, the writer, would simply collect the premium. And that's that. That's the end of the contract. However, if the stock did fall to, say, $20, as we spoke about from the other person's perspective, then the buyer of the contract would, of course, execute that contract. And the writer, the seller of the contract, would be forced, they don't have an option, they would be forced to buy stock from that person at $28 per share. And of course, if the stock's price is currently $20 and they are forced to buy stock at $28, they're immediately taking a loss, right? They will be holding a stock that they paid $28 for that is now worth $20 in the open market. In this case, Phil Town was the second person in that explanation. He was the one writing the put option contracts. So what happened was the stock fell below $28 per share. It's now at about $24. And as a result, when that contract was executed by the other party, the other person on the other side, he was forced to buy the stock at $28 per share. So why on earth would he do this, right? Why wouldn't he just, for example, wait for the stock to fall below $28 and then just buy the stock? Well, what Phil Town is doing here is a way of generating some income while he waits for a business that he wants to invest in fall into his buy range. Because while the stock is above $28 per share, and we can assume that $28 was the start of his buy range, or it's a price that he would be comfortable paying, while the stock was above that, he can sell these put options, he can write these put option contracts, and as long as the stock doesn't fall below $28 or around that minus the premium, then he just collects the premiums. However, if the stock did fall, which is what happened, he's also happy to buy the stock at $28 because according to his value investing, his valuation, that would be an appropriate price to pay. So he doesn't really mind that the stock is now below that or even further down. It's just a way of collecting some income and actually lowering your cost basis while building a position in a stock. So I think that's enough about options, but I hope that was kind of a nice explanation of how writing put options works. Phil Town talks about this quite frequently now as a strategy he uses to generate income. But let's talk about Sprouts Farmers Market, which is actually the company that he is now invested in. And assuming because he was writing these put options, we would hope to assume that he thinks it is a great business because otherwise that would be incredibly risky. He would be forced into buying stocks that he didn't really believe in. But I actually just recently did a full deep dive on this company. If you're unaware, every 2 weeks for my Learn by Example program, I do a deep dive into a company. And this isn't to provide advice on these companies, but they serve as really good examples of what good companies look like, what bad companies look like, as well as giving you a lot of examples of how I approach evaluation and how I'm projecting growth for those businesses. If you want access to the full report, which is 11 pages long, and there's a 60-minute analysis presentation where I break down my analysis of the company and explain where I got the data from and all of that, as well as the over 100 hours of exclusive content that's also on the site, then check out the link in the description below to learn more about becoming a student of Learn by Example. But Sprouts Farmers Market was founded in 2002. It's an organic grocery chain, very similar to Whole Foods, but considered kind of a discount version of Whole Foods, which is really, really expensive. And currently, they're a pretty small chain. They only have 362 stores across 23 US states. And their business model is pretty simple. Their plan is to continue to open more stores, become more efficient at opening more stores. They want to see a 20% decline in the cost of opening and capital expenditures related to openings. They're aiming for a 40% cash-on-cash return on their on their new grocery stores that they're building by the 4th year. And they're, of course, trying to see some increases in the revenue produced by each of their stores, which is currently at about $17.9 million per store. So their business model is relatively simple as long as they can execute on it, which we'll talk about a little bit in a second. But if they're able to execute on those simple things, then you would expect they can continue to expand across the United States and may very well be a good investment. And in this video, I'm not going to go through everything, of course. That's impossible to get that out in a 15-20 minute video. But I just want to talk about some of the things that I thought were really good about this business. And then there's a couple of things that I think are really bad about this business that really means overall, I'm probably not going to invest in this company or even look further into it. But in terms of the good, the best thing about this business is honestly its valuation. It currently trades very, very low relative to its current earnings. And if you believe what management is saying about the future growth and their future growth plans, and you put that into a discounted cash flow model, then it can be a very, very lucrative investment if they meet management's expectations. So management's plan is to increase their store network by 10% each year starting in 2022. So that would mean they'd be opening about 30 new stores starting in 2022. They want to combine that with low single-digit comparable store sales growth, so increases in revenue at existing restaurants. And that would combine for low teen growth per year in profitability. And if we model that in a discounted cash flow spreadsheet, this one's mine. You can download a free copy of it if you're interested, linked down in the description below. We're looking at an expected return if they can do low teen growth of about 18% per year. So basically, if management is right in what they're projecting forward, if they can do what they say, then the stock will deliver significantly better returns probably than the rest of the market. However, there's some things about the business that make me doubt or give me less confidence that the business is going to be able to achieve those things. The first concern comes in regards to the revenue growth, the comparable store sales growth of some of their existing restaurants. In previous years, you can see that they were achieving high single-digit comparable store sales growth of 6, 7, 8% in some years. And that's a really good sign that customers loved shopping at their stores. But in the past 5 years, growth has slowed to almost a halt if you exclude 2020. And this is likely being driven by two factors. One is that they're mature stores, which were really, really successful, as you can see from some of those older year comparable store sales growth. Some of those stores are probably maturing and as a result seeing slower growth, but that in combination with what's likely happening, which is that as they expand across the US into new states, they're just not seeing the same success that they saw in some of their more local markets, such as California and Texas. In 2020, comparable sales growth picked up, but that growth is a massive outlier. And if you actually look at the first 2 quarters of 2021, comparable sales have been between -8% and -10% this year so far. So the increase in sales from 2020 have almost completely, if not entirely, been erased in the first half of 2021. But despite this, the company has actually been able to grow at really high double-digit double-digit growth for a really long time. And the way they're doing it is they're expanding their store network. They keep building more stores, or they acquire some stores, which they did in between 2010 and 2014, I think. And of course, that can allow the business to grow, but what gives us confidence in the business thriving over the long term is, of course, the performance of the underlying stores, which we see in comparable store sales growth, and that has just gotten weaker and weaker over time to the point where comp sales over a 2-year period, 2020 and 2021, is now starting to look negative, which is really not a good sign for them at all. My other concern is in regards to the management team. So up until 2012, the management team was made up of the founding family. So the Boney family has been running Sprouts and other grocery chains back since, I think, the 60s. It was like 1965 or something. And there's been 3 generations of this family that had been involved in grocery chains that were related to Sprouts, if not was Sprouts, which was founded in 2002. Unfortunately, in 2012, the last person who was in the family of the founders left the company. He stepped down as CEO. And now they just have this brand new management team. They have 8 executives. 6 of them have just come to the company in the last 5 years. So it's a brand new executive team. We have no track record of their performance at Sprouts, so we can't really use measures like the return on invested capital to assess their ability to invest capital within this business specifically. And the management team pretty much holds no stock. They get compensated quite well, but even the CEO has a habit of selling a lot of stock. In the last 3 months, he sold $1.5 million worth of stock, and he only has about $2 million in his personal portfolio. So he sold almost 50% of his position just in the last 3 months. And I didn't even look back at other periods. I'm sure he probably has a habit of consistently selling his stock. And that doesn't necessarily mean I think the business is going to fail. I always have to say this, right? When I don't want to invest in a company, it's not because I know it's going to fail or I think it's going to fail. It's simply that it doesn't have the characteristics of a business that gives me confidence that it's going to thrive. I've given you a couple of examples, but there was actually quite a few other things that were not quite good about this business, including the level of debt that the company has. But that's kind of my thoughts on Sprouts. I certainly don't agree with Phil Town on this investment. I think that it looks really cheap, especially if you're just looking at surface level numbers and you're just looking at the growth of EPS and cash flow and revenue. The growth looks terrific and it's really cheap. But if you dive into what's driving that growth, it looks like the underlying grocery stores are not really performing all that well. But I'd love to hear your thoughts down in the comment section below. And as I said, if you do want to hear my thoughts on Alibaba, the kind of teal deer, really short version is that I'm not going to invest in Alibaba, I don't think, because I feel really nervous. I don't feel confident investing in businesses that operate within China and under Chinese regulations. But if you do want to hear my full thoughts on that and maybe a breakdown of Alibaba, then feel free to let me know down in the comment section, and I can also take a look at that if that's something you guys want to see. But I hope you guys got some value out of today's video, and if you did, I would very much appreciate it. Take the 2 seconds to leave a like on the video, and make sure you hit that subscribe button if you want to stay up to date with content that I post in the future. But with that said, hope you guys have a great day, and I'll see you in the next video.